I'm going to go ahead and record this one. So on the previous day, I had made an entry in Alcoa. It was down around 8:06, and it looked like a washout pattern on a long period, and then on an intraday basis, and it was starting to get some legs. It closed really well, and so I had a swing trade position. I kept the swing trade position on overnight. It closed around, as you can see, about $8.20. So I had about a half an hour in that position on the swing trade, because I used a 30-cent stop, and it was up 15 cents for my entry. So I'm a half an hour into that. When it opened, it started chopping around, and I didn't like this triangle formation. It didn't look like it was making headway. The market was looking initially weak, and so I exited at 8:21 in this red circle here. About 15 minutes later, it broke out and made a new high of the day. And the market was working, and so I just went ahead and re-entered. And this is one of those, almost like if this was a frog trade, it would have been brilliant. The frog standard deviation in Alcoa is like I think it's like 8 or 9 cents. So you can enter here, even on the frog, at about 8:23 with it. Let's call it a 10-cent stop, and you end up getting a reasonable exit up here at 8:49 near the close of the day. You know, so you're talking about 2.5 hours just if you treat it as a frog trade. Because I was using a 7-cent stop, I was a little more active on this one. I had entered here, entered another one at 11:30, and another one at about 12:30. Inside this blue circle, when it started going sideways again, my thinking was that this is not a runaway train. So I end up peeling off. I got about two hour in hand. I go ahead and cash the 2 extra bullets that I put in for a couple R. Immediately thereafter, naturally, it takes off. I did not add any more in. I'm still working the same initial position, entered at 8:23, and then near the close at 8:49, I decided to go ahead and get out. And so on that trade, that's almost a 4-hour trade on a turbo. And this little chart right here just shows some of the reasons why you might be interested in turbo trades and intraday trades, because your position size can be large. And in this case, it was a combination of both the frog 9-cent standard deviation and my customary 7-cent Alcoa stop, and then I was using the river as a way to guide my decision making, to manage that trade a little more carefully. If I had just used frog technique, I wouldn't have any of that stuff on there, and I could have I'd still have a nice trade in that. My sense is that when you combine the frog with the regression line crossover, you can engineer your exits a little more carefully. But the other point I want to make too is that if I wanted to stay with this as a swing trade, what I could do is I had the swing trade from the previous day added to it with turbo here, so I'm a larger position size intraday, peel those shares off somewhere in this upward move, and then somewhere near that red circle, reduce my position size to make sure I'm only carrying overnight how much I would on the first night, which is using a 30-cent stop instead of my 7-cent stop. So it's basically selling like 3/4 of the position. The reason I didn't want to hold any of that overnight is because it was a weekend, and I don't like holding over the weekend, so I just went ahead and cashed all out of that. So this was anywhere from like a 4 to 5 hour trade once you add up all the little pieces. So just like in that last Alcoa trade, I'm always kind of getting out too soon, or I'm getting out at signs of hesitation rather than waiting for measured pullbacks. This is just an example of, this is in TNA, which is the 3X Russell. And so I had made an entry when it broke out of the river, late in the morning at about 11:30 in the green circle. And then in the green shaded box, you can see this thing has moved out of the river, and now the regression lines are both out of the river moving up. It makes what I thought was a parabolic move up above 48.70, came back, ran up again, not quite as high, came back again, and it was enough to get me out at about 48.67, somewhere in this red circle. The regression line crossover happens shortly thereafter. You have to be out in this kind of a strategy by the time that regression line crossover occurs, which means you're getting out here somewhere north of the Bollinger Band mean. But I don't like giving back that much, especially after a nice short, sharp move like that gave me plenty of warning, because I know how to get back in, but I like preserving that move. Well, when the regression line crossover occurs outside of the river, the target is back to the Bollinger Band mean. You can see that happened. It bounced again, didn't make quite as high a move, and started chopping around again. And what I see now is that green shaded area that was good has now become this kind of sideways, quiet, choppy channel. And then pretty quickly at 48.47, when the river is narrow, you see how quickly the bottom drops out of that thing. And it goes from 48.47 down to 47.87. So that's like 60-cent move. That's 1.5% in a matter of about 10 minutes. And not only is that tradable, but it's also darn right deadly if you'd been trying to hold on thinking you were going to get a bounce from your earlier trade. So I tend to try to get the pieces that I can see, and then I let re-entries and ongoing risk management decide to get me back in. I just found it interesting that this thing, when it broke out of the river, came down immediately to the VWAP and then blasted right through it, and basically gives back all of the gains that you worked so hard to get in the first piece going up. So that's one of the reasons I don't really worry about getting out too early. It happens all the time. This one was a trade that was favorable, and I was tracking IWM and UVXY. That's the volatility ETF, and just as a way of getting a read on the markets. You know, at the time that IWM had failed out of it had a regression line crossover right after half an hour into the session. So this is 9:54. It rolls over, comes down to the edge of the river. This is where I get short at 77.38 when it leaves the river. And that happens right at the same time that the VIX is leaving the river and getting ready to pop up. So when those two things happen simultaneously, that's telling me that the hedgers are putting their money on protecting against downside moves by going along UVXY. So that's one where you can either take this one long or that one short, or some combination of both. It's really, in my view, it's really kind of the same trade. This is one I want to just remind you of from last Wednesday on the daily. I put a note on this in the chat room as well, that at that moment, this is before the last 2 days when the market found support and is now up almost at 139. That Wednesday at the close, it had come down to the bottom of the regression channel and found support, which is why I circled that. And I said this is really a perfect place for a swing trader to be looking to go in either direction, because if it fails out of the regression channel, it's going to go down to 131, which was the previous support level, and if it breaks there, it's down to the 200-day moving average. So you get a really nice move potential to the downside, but you also have a really nice move to the upside, which I identified at about 138.5, which was the previous support levels in the top of the regression channel. So you're really poised right on the edge of a knife here. The teeter-totter is perfectly balanced, can go in either direction, and the move is likely to be large, is what we said Wednesday. So I'm not saying that we were predicting an up move. What we were saying was it's a perfect location for short-term, sharp directional moves, which is well suited for frog traders. Let me see. There's question in here. Hold on.